What if your law firm could write a check for your student loans and give you up to $5,250 tax-free? Welcome to the Lawyer Millionaire, helping law firm owners grow their businesses and their wealth. I'm your host, Darren Wurz. Are you suffocating under six figures in student debt while watching interest rise again and forgiveness stalled? With 68% of young attorneys reporting severe stress from education debt and up to $112,500 in median loan balances at graduation, the pressure is real. You're not alone. And today's episode is all about creative repayment options, including loan forgiveness. All right. Hey there, Lawyer Millionaire friend. Before we dive in, I want to quickly tell you about our Lawyer Millionaire Listener Challenge. All you need to do is leave a review and share your favorite episode with a friend or on social media. Then head on over to lawyermillionaire.com/challenge to submit your proof, and you'll be entered to win a $100 gift card, a signed copy of my book, and even a private strategy session with yours truly. The link is in the show notes. Let's go. Get your entry in today. All right, so we're talking about student loans, and we're in part 4 of our series on student loans. Big topic, a lot of changes happening with the recent legislation, the one big beautiful bill passed here recently in July. So let's talk about a few things. I want to give you some ideas on repaying those loans. That's the idea, right? We want to get those loans paid down. So we're going to talk about a few things today. Forgiveness programs, we'll review what those are and what the changes are to forgiveness programs. Then we're going to talk about some creative repayment options that you may not have thought about before. And then we'll talk about some risks and mistakes to possibly avoid in that process. So let's begin with what still works and what's still available. And what is still available is the Public Service Loan Forgiveness, or PSLF. This is still a remaining option. It will forgive up to 120. It will forgive your remaining balance after 120 qualifying payments while working full-time for a government or a nonprofit employer on a qualifying repayment plan. So there's a lot of qualifying things in there, but basically, if you're working for 10 years, so 10 years times 12, that's 120 qualifying payments for a government or nonprofit institution, then you can qualify for loan forgiveness under the Public Service Loan Forgiveness option. It still is active today for borrowers who had it in place before July 1st, 2025, but there's still risk. Congress could change that. New laws could come up, and the future rules could change, and future rules might even tighten employer eligibility or limit it completely. So you want to be aware of that and pay attention to that. And one of the things you want to make sure if you're on this type of repayment plan and you're aiming to achieve this forgiveness is make sure that you are submitting your employer certification forms annually to avoid payment, that forgiveness option being voided for you. Now, what's gone? Well, there was a popular option called the SAVE plan, which was created under President Biden. The SAVE plan has pretty much gone away by court injunction. Has pretty much blocked the SAVE plan. And on August 1st, 2025, interest accrual has now resumed for approximately 7 to 8 million borrowers who were previously in interest-free forbearance. So what had happened was they knew that the SAVE plan was going to be done away with. And so President Biden put everybody that was on this plan into 0% forbearance. Well, that is now over. Payments will remain paused for those borrowers, but interest will not be paused, right? And none of those payments will count towards forgiveness unless you switch to a new plan. Let's talk about income-driven repayment options. These are pretty popular. A lot of folks on income-driven repayment plans, very helpful for when you're starting your law firm and you don't have a lot of income right away. So legacy income-driven repayment plans are going away. The repay plan or revised pay-as-you-earn, the pay plan, pay-as-you-earn, and the income contingent repayment plan are now all functionally blocked for forgiveness as far as forgiveness goes. So those are no longer an option if you're looking to achieve forgiveness. The income-based repayment plan is the only income-driven option still intact and not blocked by court rulings, though forgiveness processing is still paused. There's about a $1.5 million case backlog right now, so it's taking a while. Borrowers who are enrolled in income-driven legacy plans should think about consolidating and re-enrolling in the income-based repayment plan to preserve your forgiveness credit. But applications may move slowly. Just be aware of that. There is a new option that has come available. It's the RAP plan, or the Repayment Assistant Plan, passed under the recent bill on July 4th, 2025. So starting July 1st, 2026, all new federal student loan borrowers must enroll in either one of two options: the standard repayment plan or the new Repayment Assistance Plan, or RAP. So what is RAP? Well, RAP caps your monthly payments somewhere between 1 and 10% of your income and extends your forgiveness timeline to 30 years. So it's kind of like the new income-driven plan. It will include interest waivers and possible principal matching credits, but forgiveness could be taxable under this plan. So just be aware of that. If you are on a legacy plan, you must switch by July 1st, 2028. So you got some time to hang out on these other plans, but by July 1st, 2028, you're going to have to switch or be automatically migrated to one of those two plans, the standard repayment plan or the RAP. And if you don't make a decision, you could lose your forgiveness eligibility under the income-based repayment option or the public service loan forgiveness. So a lot of moving parts here. You may want to consult with somebody who knows a little bit more about this. If you want to speak one-on-one with me or a member of my team, we'd be happy to. There's a lot of things that are changing in the forgiveness world and in the repayment options world. Okay, but enough about that. Let's get creative. Let's talk about creative and strategic options for repaying your student loans. So one of my favorites is paying your student loans through your law firm, if you're a law firm owner. And here's how this works. So instead of paying your loans personally, you're going to have the firm issue a draw to you or a bonus and earmark that for loan payments. Now, if you just do that, okay, it's going to be tax deductible to the firm, but you're going to still pay tax on it as income. But here's something you could do that's a little bit fancier. So there's something called a Section 127 plan, and you could create a Section 127 plan for your firm. And through this plan, you could pay up to $5,250 per year towards your employees' qualified education loans without triggering federal income for them or payroll taxes for you. Now, you could do this for yourself as an employee of the firm. The key is, this has to be offered to everybody. So if you have a lot of employees, that may not be something you want to jump into right away. But if you're a small firm or even a solo, you could do this, right? So you can have $5,250 from income that you pay towards your loans that you don't have to pay income taxes on. How does that sound? Well, that sounds pretty great. So it was fully deductible to the employer, right? And then it's not taxable to the employee. If you're the employee, it's not going to be taxable to you. Now, if you're a solo, caution, you want to make sure that you have proper documentation so that the IRS doesn't come knocking, take you through an audit and say, nah, we don't like this. Okay. All right. Another option is the family bank method. Yes, we all have that one family member who always asks for money. This isn't that. You're not going to be that person. You're going to borrow from the family, perhaps, and promise to repay, but borrow and pay at maybe a lower interest rate, 0% or more favorable rate. You may not want to do this for those loans that are, have the possibility of being forgiven, but other types of loans, that might be a great option for you. Hey, mom or dad, could I borrow 50 grand to pay off my loans and I'll just pay you and pay you less interest? Maybe. Okay. Or maybe you have a rich aunt who can help you. Um, Bonuses and windfalls. We talked about this on the last episode, or 2 episodes ago, episode 2. Using found money, lump sum distributions, extra money that comes in, those can all help accelerate your principal pay down and get those loans paid down faster. But you want to be careful because windfalls could have an effect on your repayment if you're in one of those income-driven repayment plans. So be careful of that. Another option is using your home equity. Maybe you've been out of law school for a while and you bought a house and real estate market's been great over the past few years. Your home value's up, you've been paying down that mortgage, and you have some equity. You could do a cash out refi or do a HELOC, home equity line of credit, and basically borrow against your home to pay some of those high interest loans off. The interest on borrowing against your home likely will probably be lower than your interest rate on your loans, especially now that interest is resuming on student loans. So post 2025, though, there's something to be aware of. The interest is only deductible if the proceeds are used to buy, build, or substantially improve the secured property. So no longer can you take out a HELOC to pay off your student loans and the interest be deductible for you. There's also a risk here you want to be aware of. You're turning unsecured federal debt into secured mortgage debt, and basically you're using your house as collateral. So there's the possibility, if you're not able to pay that mortgage and pay off that home equity line, of foreclosure if you're not able to make those payments. Another option is borrowing from life insurance policies. Now, you may not be old enough to have accumulated cash value in those cash value life insurance policies, and I'm not really a big fan of those cash value life insurance policies myself. But if you have them and if you have about a nice cash value, perhaps you could borrow against that. But be aware, policy loans. So the good news, policy loans are not taxable, but caveat, when they are properly managed. They also don't require credit checks, and they won't count against your credit score for having an inquiry. So that's kind of nice. But you could put your policy at risk. You could reduce your death benefit, and there's a potential for policy lapse or taxable consequences if that and taxable consequences if that policy lapses. Okay, and now I want to wrap up with a few planning pitfalls and things for you to watch out for under the new law. Number 1, missed recertifications and processing delays. Maybe you have been hiding your head in the sand as it regards your student loans. Just be careful not to miss those recertification deadlines, especially for income-based repayment forgiveness. You want to make sure you're not avoiding your forgiveness eligibility. Number 2, be aware of that plan migration deadline. If you're not in an income-based repayment in the IBR by July 1st, 2028, you'll be automatically migrated to the wrap or the standard repayment plans and possibly lose your forgiveness eligibility. Number 3, the tax bomb risk for IDR forgiveness, income-driven repayment forgiveness. Forgiveness under IBR or legacy income-driven repayment plans may be taxable after 2026 unless Congress intervenes. And so Congress needs to extend the tax exemption that was established under the American Rescue Plan Act. If they don't, after 2026, there could be taxes on that forgiveness. Next one, over leveraging your assets. If you're going to use home equity or insurance policies, make sure that you're not over leveraging yourself. And also make sure you're not giving up the possibility of forgiveness and losing potential benefits that you have. And last but not least, record keeping is critical, especially if you are on track for forgiveness. Collect and retain copies of your employer certification forms, loan consolidation paperwork, IDR elections, recertifications, payment logs, etc. Just make sure you're keeping all your records. Well, folks, this isn't all about just knocking out debt. It's really about accelerating your long-term wealth creation. When your firm can legally cover your student loans in an intelligent and tax-efficient way, you're freeing up capital for real wealth building. And that's what we're all about here at the Lawyer Millionaire. And we help law firm owners every day map out exactly how to structure these opportunities safely and strategically. So, friend, if you enjoyed today's episode, help us spread the word by participating in our Lawyer Millionaire Listener Challenge. Leave a review, share an episode, and submit your entry at lawyermillionaire.com/challenge. And you can submit multiple times and get multiple chances to win one of 3 great prizes. And if you want to talk one-on-one, you can always book an intro call with me using the link in the show notes. Who is the Lawyer Millionaire? It's you, my friend. Own it and live it. I'm your host, Darren Wurz. Thanks for joining me. See you next time.